buy-side firm is essentially any entity that purchases investment securities. Buy-side firms often purchase these securities from the sell side and do this as they aim to create value and returns for their clients. Examples of buy-side firms include mutual funds, hedge funds, pension funds, unit trusts, proprietary trading firms, and private equity. Due to their large client bases, some buy-side firms benefit from economies of scale by having large pools of funds available to invest with. Consequently, their trading decisions can involve buying large blocks of securities, which means that they often have a great deal of market power. As such, their investment choices are usually watched very closely by the investment community at large. Buy-side firms have long been some of the most profitable on Wall Street. They arguably began their rise to dominance in the 1960s and 70s, and by the late 1990s, institutional assets under management had soared. For example, by 2001, it has been estimated that assets committed to equity mutual funds alone had hit $4.1 trillion. Alongside this increase in AUM was an increase in fees, and therefore revenue, that such firms could charge in a world where limitations in technology had restricted the ability for many to access the marketplace. In the post-financial crisis world, though, buy-side firms have seen their margins compressed and have had to react accordingly. Due to a combination of increasing operating costs from a tougher regulatory environment, stagnating demand in developed markets, heightened competition, and a need to diversify offerings to appeal to a changing client base, 4 key trends have developed since 2008 and 2009. The first trend is automation. Successful buy-side firms continually search for ways to outperform the market and their peers. For this, a popular theme has been to enhance returns by reducing costs and inefficiencies. Margin pressures initially forced buy-side firms to streamline their core technology and operations to achieve efficiency savings. This has resulted in technology suppliers, like Bloomberg, expanding their functional footprint across different parts of the buy-side firm as they rationalize, consolidate, and pivot their application landscape towards a more fit-for-purpose configuration. This has been especially true for trade and order management, OMS and EMS, as firms execute more of their order flow directly. In this area, some firms have collapsed up to 6 applications down to just 1 or 2, while adding the ability to closely monitor the quality of their execution and the allocation of their transactions to ensure that there are no conflicts of interest. This is because the onus is now on the buy-side firm to not just measure and track the performance of portfolio managers, but to also ensure that all clients are treated fairly and equally. The trend of automation is expected to continue in the foreseeable future, but now into such areas as portfolio management and construction, with an interest in better aligning applications for derivatives and alternative investments. Related to this are the areas of risk management and performance attribution, as these are areas that have data sets and analytics that overlap significantly. What is interesting to firms like Bloomberg, though, is that some estimates have placed cost reductions of up to 25% if these buy-side firms streamline their operations by adopting an ecosystem approach and consolidating it with one vendor. The second trend is the move from active to passive investment management. Since the financial crisis, a cutthroat pricing war on the fees charged by passive funds has created unrelenting pressure on the revenues of buy-side firms. Investors have flocked from expensive, active investment management to cheaper, passive investment strategies. This has been most noticeable in equities, where there has been a marked trend from paying stock-picking experts to instead using ETF trackers. Consequently, this has severely reduced the amount of fees that many buy-side firms can charge and has brought the concept of outperformance or alpha generation firmly into the spotlight. Now, it is only those firms that can demonstrate a sustained ability to outperform the broader market who can justify the large fees associated with actively managing investments. To put into perspective just how big this trend has been, data from the Investment Company Institute suggests that assets in passive investment vehicles reached $11.4 trillion at the end of 2021, of which over $6 trillion are held in exchange-traded funds. This means that more assets are now under management in passive funds and active strategies, with BlackRock estimating that global ETF assets could reach $12 trillion by the end of 2023.
The Bloomberg IP Go function allows users to examine the investment trends of major asset fund managers. Click on the screens on the left to compare two major global fund managers, Vanguard and PIMCO. Which of the statements on the right is correct? Click Answer to submit your response. Correct. Vanguard is a passive fund manager, though more than 12% of their funds are actively managed. Click Continue to move on.
The third trend has been the investment in non-traditional assets. Due to the change in economics of the post-financial crisis world, the buy-side's hunt for increased returns has generated a demand for alternative and increasingly more exotic assets. This is not just limited to fixed income and equities, but also extends to relatively established assets such as private equity, hedge funds, and real estate. There has also been expansion into other so-called emerging alternatives such as infrastructure, private debt, insurance, and bank-related assets. For established asset classes, exotic and more complex structures have been coming back into fashion. For fixed income, this includes such instruments as asset-backed securities, or ABS, CLOs, CMBS, RMBS, and synthetic CDOs. While on the equity side, there has been an increase in usage in derivatives, for instance listed vanilla options and exotic versions of variance swaps. Given the complexity of these instruments, the cost of building a customized in-house solution is often high. Thus, in turn, it has created a further demand for an external technological solution.
Commodity ETFs allow financial investors to gain exposure to non-traditional assets without having to physically own and store bulky commodities. The Bloomberg MTL Go function lets investors see which precious metals are being bought by ETFs. To see holdings, navigate to each of the ETF holdings subtabs for metals. Over the last 1 year, which precious metal has seen the biggest increase in demand by such financial investors? Click on the tabs to find the answer. Click Answer to submit your response. Correct. When you compare the last column, percent change 1 year, you can see that palladium has the largest increase over the last 1 year. Correct. When you compare the last column, percent change 1 year, you can see that palladium has the largest increase.
The fourth trend has been regulation. Since 2009, regulatory pressures on the buy side has continually added further costs as firms strive to be compliant and avoid operational risk. Such regulation as Europe's MiFID II and the market abuse regulation, and in the US, the SEC's National Exam Program, while designed to increase investor protection, have meant that firms have had to divert resources towards being extra vigilant to monitor and protect against insider trading, front-running, tailgating, spoofing, and layering. Away from their day-to-day operations, buy-side firms now have the extra costs of also monitoring their employees' personal trading activity outside of work, portfolio misrepresentation, and any other potential conflicts of interest within the firm. Buy-side firms were largely unprepared for this increased regulatory burdens, especially in some areas like monitoring electronic communications. This has meant that returns have reduced as the firm's cost of doing business has increased. This has been mostly due to the extra expense paid to implement technological solutions and the resulting administration to comply with reporting requirements. Overall, therefore, you can see that since the global financial crisis, new technology is critical to a buy-side firm's competitive advantage. This is only going to increase, though, as the buy-side begins to invest in new areas like machine learning, big data, and environmental and social governance as they continue to evolve profitably in the post-financial crisis world.